Now we have a few slides on documentation. Documentation, again, this is our auditor's work papers. Remember our rule of thumb, if you didn't document it, you didn't do it. Okay, so read through this on your own. It should all make sense. I promise I wouldn't lead you astray here. This is all very straightforward. This is all very straightforward. So I'll let you read through it on your own. And then this is all very straightforward. The one thing I'll point out is it sort of talks about the fact that the audit work papers, if you're going through and reviewing them, you can tell through reading them basically all the work that has happened, which again should be obvious because if you didn't document it, you didn't do it, which implies everything that you did do is in those work papers, right? What happens after each of us goes through the work papers is the person who does the original work and every person who subsequently reviews the work signs off. So, for instance, I would do my little sign off, and then every person that comes after me is going to sign off the same way, and we all sign off in kind of a row in the lower right corner of the work paper, and then everyone who comes after can see, okay, these are the people that worked on it. It also means anyone coming in later, such as a PCAOB reviewer, a peer reviewer, or hopefully not, but if our records ever get subpoenaed, somebody in the stand, if we ever wind up on the stand and have to explain what we did, they know exactly who worked on this work paper in this audit area. And of course, today with most things being electronic, there are electronic sign-offs too. There are always both current files, which those are going to relate only to the year under audit. So if I'm auditing 12/31/19, my current year files are just for fiscal 2019 only, whereas my permanent files, those are going to be things that relate to just the company in general that apply across the board to all the years. And I would carry these things forward and back for all my years. So they can be things like important contracts. So think about that if the bank has like a 5-year revolving debt agreement with a bank, that applies for 5 years. So I wouldn't want to have to ask the company for that or my client for that every year, right? That would be kind of embarrassing. So instead we keep it, things like that, in these permanent files, and then we have them year after year after year, and we can just bring them out. For the format of audit documentation, I'm not going to talk about it much today, these things, and I wouldn't honestly worry about them much for this test. I don't think I'm going to include anything. I will explain these things more to you when we get into chapter 10, 11, 16, so on for the final, because we're going to be, for those chapters, looking at actual work papers and actual examples of work papers. So I will show you examples of tick marks, headings, cross-referencing, so you can actually see them in real life. And that will make much more sense than these definitions. So I would say don't worry about this stuff for now. You will see examples of it later. The one thing I would point out here is that SOX does require all auditors of public companies, technically, to retain documentation for 7 years from the completion date of the engagement. The reason why that had to be added in SOX was shredding, right? I don't know. Hopefully you guys remember from hearing all these Arthur Andersen stories, but they were pretty notorious for shredding their work papers as soon as they found out things were starting to go poorly and everything was starting to unravel. They wanted to hide the evidence, so they just started to shred their work papers. So that's why we have this SOX requirement that you have to retain your work papers for 7 years. These are just a few slides on analytical procedures. So again, we have talked about this somewhat before. Okay, so we have different types of analytical procedures. We've talked about the fact that you can use them for different things. So we discussed how in planning you would use them for risk assessment to try to identify any strange or new transactions, any key areas of risk this year. We talked about for substantive analytical procedures, how there's different types you would do. And we had a slide in an earlier chapter, it was either chapter 3 or chapter 4, where we talked about trend analysis, and we talked about ratio analysis, and we had kind of different examples where we looked at like financial numbers and non-financial numbers, how they move together. We talked about how you would look at kind of how a balance sheet changes over time. That would be an example of a trend analysis. We said a ratio analysis would be something like how AR turnover changes over the last 5 years. Okay, so for preliminary analytical procedures, that's just helping me identify risks, and usually it is occurring at a pretty high level. So it would be just looking at a trend analysis of the balance sheet, income statement, statement of cash flow to identify any unusual accounts popping up, big shifts in balances. For substantive analytical procedures, you're doing those at the individual balance level. So this would be something like, how has AR turnover changed over the last 5 years, right? And I'm doing that while I'm doing my substantive test of AR. Final analytical procedures, again, they are going to be at kind of the macro level. So looking at how the whole balance sheet or income statement has changed over time. This is an overall review at the end of the audit, which kind of will help you make sure that you have not missed anything during your audit. In theory, you should not find anything in your final analytical procedures that you don't already know about, because if you find something there that surprises you, it means you've missed something in your substantive tests. The one type of analytical procedure that I want to talk about for a few minutes now is the reasonableness analysis. And this is one we have not talked about at all yet. So a reasonableness analysis is a type of analytical procedure where we form an expectation model. And this flowchart, which is in the book too, I believe this is one of the advanced sections at the end of the chapter. So this flowchart shows you the various steps for the reasonableness analysis. A reasonableness analysis will be a type of substantive analytical procedure, so we'll be doing it over a particular balance. So the first step is to develop an expectation as to what we expect a balance to be, or how we expect a balance to change, something like that. That's the sort of expectation we're talking about. I will show you a specific example in a minute, so if you feel like you have no clue what I'm talking about right now, just hang in there. Step 2 is defining a tolerable difference. So before you compare your expectation of the change or balance to the actual change or balance that the company has, which is step 3, you want to define a tolerable difference,
which is typically going to be allocated TM for that account.
And then the third step is you compare what you expected the balance to be
or how you expected the balance to change to the actual balance or actual change.
The difference between your expectation minus the actual, right? And you compare the difference versus your tolerable difference, which we define up here, right? Is usually your allocated TM for that particular account. Then if your difference is greater than your tolerable difference, you're going to want to investigate what's going on, do inquiry, also get backup support for whatever the whatever the inquiry reveals, you'll want to get backup support for it. If the difference is less than your tolerable difference, you're good to go. All right, so I want to show you a specific example here, right? So I sort of mocked up a depreciation reasonableness test. So this is a really common type of analytic that auditors do. You almost always see this. So this is depreciation expense. I should have specified that. So basically, remember, the first step is you develop an expectation for what you think the amount or change would be. So in this case, I want to develop an expectation for what I think depreciation expense is going to look like. Let's say in this case, I have 3 different categories of PPE, and then you're going to have your depreciable base for those categories, because you wouldn't want to include fully depreciated assets. You would only want to include assets that can be depreciated. So that's why I'm starting with my depreciable base. And then you'll have, for each of these categories of assets, you'll have your useful life or average useful life for that category. And this can usually be found in the company's policies and procedures. It should say what their average useful life is for each category. Then, based on the company's policy, you should be able to estimate for any given category what their depreciation expense would look like for that year, right? So, assuming that they use straight line depreciation, you can say, all right, so I assume they would depreciate each of these assets by this much each year, okay? And then I would sum these things up. So this number here would represent my estimated depreciation expense for the year. What you would want to compare that to, right, is the company's actual depreciation expense. And then you need to know the difference. And so this is the stage where it tells you, okay, so you want to define your tolerable difference here. So let's say my allocated TM for PPE for fixed assets is 1/4 TM. So I'll say I want to investigate differences over 1/4 TM. And I can say, so let's assume TM is 1 million. So I can say, okay, it's 1/4 TM or 250K. All right, so let's say, just for sake of example, the company's actual depreciation expense was 4 million. Then I would compare the estimate I came up with to their actual to find the difference. And so this difference, again, is what I am going to compare to my tolerable difference for this test. And in this case, it's beneath my tolerable difference, so I'm good to go. I could actually just say the difference is immaterial and move on with my life. But if it was more, then I would need to investigate it. Okay, this slide is just telling you, hey, there's a variety of different things you can use to develop your expectation in this step up here. So you can use things like the company's budget, internal budgets and forecasts. You can use how a competitor's doing. You can use the analyst report. This is also giving you some guidance on how to define your tolerable difference. So things like how precise your expectation is can weigh into this, right? So if I had been doing some kind of super precise calculation right here, then I might be only willing to tolerate a really small difference here because I would be expecting that I would be very, very close. But because my calculation is this type of calculation, to be frank, is pretty rough, I'm willing to accept a much larger difference. The size of the account comes into play, how much you want to rely on the procedure. So risk, of course, always. I'm not just telling you to compare and investigate. This is just saying when you're doing planning analytics and versus final analytics, they tend to be very similar procedures. So we talked about this idea that both tend to be in the form of these trend analyses, looking at how balance sheet, income statement accounts have changed over time. The one really big difference between the two is when you're planning, you're just trying to identify risks in particular accounts. So if you find big shifts and things like that, really you just have to inquire with management to ask them what's going on. You don't have to go get corroborating evidence for what they say, for their explanations. With final analytics, if you find something that you don't already know about that appears unusual, you can't just get management's word for it. You have to actually go get additional evidence. These last few slides are on the ratios. So my take on the ratios for you guys is, I know you have learned them probably 10 times by now. You have memorized them, crammed them, and probably forgotten them. What I would like you guys to know is remember the point of these ratios. So I may say, have a question that requires you to know the current ratio or the quick ratio or measures of liquidity. I do think that it is important that you would know that. However, you don't have to know or memorize the formulas for the ratios. Okay, if I wanted to ask you to calculate any of these ratios, I would give you the formulas, provide them on the exam. Okay, so know what they mean, okay? Know what they stand for, kind of what they represent, but you don't need to memorize formulas.